You ever get that feeling that the economy is, well, playing by a completely different set of rules? That there are these hidden forces, moving the markets and your money in ways we can't quite see? Well, today we're going to pull back the curtain on those very forces. We're diving straight into what I'm calling the Fed's $1 trillion dilemma.
So think back to the decade after the 2008 crash. We were living in what everyone called the everything rally, and it was wild. Stocks, bonds, real estate, you name it, it just went up and up. The whole financial system was just flooded with cash, and that fueled this really powerful mix of optimism and, let's be real, a good bit of greed.
But that leads to the big question, right? The one at the heart of our story today. In a system that's literally built on the idea of endless money, what happens when the cash just disappears? Like overnight? Well, the whole machine can just grind to a halt. And believe it or not, that is pretty much exactly what we saw happen. Okay, let's pinpoint the exact moment the first cracks started to show. This was a moment that honestly left both Wall Street and Washington completely scratching their heads. So, picture this. It's September 2019. On the surface, everything looks fine. The economy seems okay, markets are pretty calm, and then boom, something just broke. We're talking about the repo market, which you can think of it as the super essential behind-the-scenes plumbing where banks lend money to each other overnight. And all of a sudden, it just got completely clogged. Banks were suddenly desperate for cash. And look, this wasn't just some small hiccup. The interest rate for these absolutely crucial overnight loans, that's called the repo rate, it didn't just tick up a little bit. No, it exploded. It shot up to levels that were, and I quote, many times higher than normal. It was a crystal clear signal of extreme stress. The entire system was basically flashing a giant red warning light. Okay, and this is where the story gets really, really strange. The financial system was supposed to be swimming in cash. We're talking over 1.3 times trillion dollars in bank reserves just sitting there. So how on earth could a system with that much money suddenly be so thirsty for cash? It didn't make sense. And that paradox, well, it pointed to a much, much deeper problem. So to really get to the bottom of this paradox, we have to go back to the source. We need to look at the tool the Federal Reserve used to create what was literally an ocean of cash. And that tool is called quantitative easing, or QE for short. Now, I know it's a fancy name, but the concept is actually pretty simple when you break it down. Just think of it like a giant asset swap. The Fed goes out and buys bonds from big financial firms, and in return, it pays them with brand new, digitally created cash. So here's how it works in practice. The Fed buys something like a treasury bond, and then, with just a few keystrokes on a computer, seriously, it deposits central bank reserves right into that bank's account. And these reserves, that's like the ultimate form of cash. So this process just floods the banks with liquidity, and the whole idea is that this will encourage them to lend more and, boost the economy. And the scale of this whole operation, it's just staggering. I mean, to put it in perspective, before 2008, the Fed's balance sheet was less than $1 trillion. By its peak in 2022, it had ballooned to nearly $9 trillion. This wasn't just a trickle of new money, folks. This was a full-on tidal wave. Now, a tidal wave of cash that big doesn't just change the numbers on a balance sheet. It changes something much deeper. It changes behavior. It fundamentally rewired the entire psychology of the market. I mean, think about it. Before all this QE, liquidity was king. Holding cash was seen as a smart, cautious move. But after years and years of the Fed's money spigot being wide open, that completely flipped. Liquidity wasn't something you had to manage anymore. It was just there, always. And the big takeaway here is that all this easy money made the market's default setting risk on. A really dangerous kind of complacency started to set in. And this complacency gave birth to a really powerful idea, something called the Fed put. It's this unspoken belief in the market that, hey, no matter how bad things get, no matter what crazy risks we take, the Federal Reserve will always, always step in and rescue us before a real crash. And every time the Fed did step in big, like in March 2020, or more recently with the Silicon Valley Bank crisis, it just hammered that belief home. And that right there gets to the absolute core of the problem. I mean, if you believe there's always a safety net there to catch you, what do? You take more risks. It's human nature. The source material puts it perfectly. The system undervalues liquidity and overbids it. In other words, nobody cares about having cash on hand, and everybody is willing to overpay for risky stuff, creating these huge, dangerous bubbles.
So, for a long, long time, this whole system seemed to be working just fine. But then, an old enemy came roaring back, and it forced the Fed into a truly impossible corner. And that enemy, as you've probably guessed, was inflation. Suddenly, the cost of pretty much everything started to soar. And just like that, the Fed's number one job had to switch from trying to boost the economy to trying to cool it way, way down. And right here, this is the trap. The tools you need to fight inflation, raising interest rates, pulling money out of the system, are the exact opposite of the tools you use to keep markets stable. All of a sudden, the Fed's two main jobs were in a head-on collision.
And that's the dilemma in a nutshell, isn't it? The Fed has to make money more expensive to fight inflation. But how do you take away the punch bowl when the partygoers have spent more than a decade being told that the drinks will never ever run out? So, what's the way out of this? It's a hugely complex problem, but the source material we're looking at argues that the solution requires a really radical break from the past. We need a completely new playbook.
Yeah, in this new world of high inflation, that old playbook of just unconditional support, it's obsolete. It's done. A totally new strategy is needed, one that can carefully, and I mean carefully, wean the economy off its addiction to easy money. It's all about shifting from being a constant firefighter to being more of an architect for the system.
So, what does this new playbook look like? Well, it really comes down to three key moves. First, you have to change the message. You have to explicitly say the Fed put is over. The market has to understand that the safety net has its limits. Second, when the Fed does step in, it has to be temporary and targeted. Think surgeon's scalpel for a specific crisis, not a fire hose soaking the entire system. And finally, and this is probably the hardest part, you have to reintroduce real risk. That means some companies, some players have to be allowed to fail. It's the only way to remind everyone that bad bets have real consequences.
And really, that's the ultimate takeaway here. There is no easy way out of this. Restoring some sense of balance, some discipline to our financial system, it's going to involve some pain. It means the decade-long party of easy money has to end. And that, right there, is the difficult but absolutely necessary price we might have to pay for finally stuffing this incredibly powerful economic genie back into its bottle.